Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Long grind down of austerity. If you think that, and it seems to be the only thing that's on the table, the only way to solve the relative fiscal problems of Spain, Portugal, Greece, Ireland is this idea of austerity, meaning because there's no other pressure valve, they have to reduce spending, they have to reduce wages, which means demand in those countries just spirals down, down, down. And a good example of this, of what we've seen already going through this, are the Baltics, and Latvia is one of them. Latvia is a currency that's tied to the euro, and a similar problem during the credit crunch. They put in massive austerity measures, and their GDP has fallen by 18, 20% annualized basis. It's crushing their economy. Two problems with austerity. Number one, in these major welfare states, it's going to create a lot of social unrest. We've already seen rioting. So that's a concern. So say they even get past that, which I don't think they will. Then it creates a spiraling down of demand in the Eurozone economy, which means the relative demand for German goods declines, which means, and we've already seen all the monetary numbers in terms of the monetary aggregates are falling in Europe already. So it's leading to a very much a deflationary-looking situation, and this long grind of austerity will put more and more pressure on that, which means the European Central Bank, regardless of what's going on in the outside world, is going to have to continue to create more and more credit and more money to keep this system afloat. And even if that's the situation and they're able to hang on with the European Monetary Union and it's able to muddle through, the relative growth and the relative interest rate background suggests that the euro relative to the dollar should decline in a very big way. And these are really kind of the three pillars of this as you go around this circle. That's why we call it a little bit tongue-in-cheek, but the reality is the euro spiral of death. And had you talked about this a while back, and in fact we had given a presentation back in 2000, I think it was March 2008, just when the dollar was bottoming, and the title it was "The Euro Could Soon Be History," and a lot of people in the audience started to chuckle. But guess what? Nobody's chuckling anymore. We talk about this idea of saving Greece, that the European countries collectively are going to throw $60 billion into 60 billion euro in the hopper, maybe $100 billion in the hopper to save Greece. But I wanted to show you the numbers here. If you look at the pigs, Portugal, Italy, Ireland, Greece, Spain, collectively, they're sitting on 2.9 trillion or 2.1 trillion euro of short-term external debt, meaning coming due in a year. Throwing $60 billion into the hopper, 60 billion euro in the hopper, doesn't do a lot here. And when you look at the relative debt to GDP numbers, these countries are in as bad a shape or worse than Greece. So Greece, to me, and to anybody that kind of looks past this Greece situation, is the tip of the iceberg. This number is pretty impressive. A colossal 5.9 or 6 trillion euro of long-term external debt from these countries. Now, it's pretty scary stuff. And the bottom line is, I said there, so ask yourself, how safe is the European banking system? The European banking system obviously has, from a banking system around the world, has massive exposure here. This amount of debt that was built up, because of the fact that these countries were able to borrow at such subsidized rates and German rates, they build up all this debt. And what do they do with it? They used it from a consumption standpoint and bought a whole lot of German goods. And they built a lot of houses and things like that. So the relative debt buildup didn't go into stuff that initially was the goal of the Eurozone. One of the reasons the brain trust of the European Monetary Union allowed these countries to borrow at German rates was the assumption that they would increase the efficiencies of their economies and make investments in capital, make investments in lowering the rigidity of their labor markets, and increasing the productivity of labor. But what's happened? They've used all this money to buy German goods, and the relative labor productivity of Germany has soared compared to these countries. So they're stuck in a very, very big problem. From a productivity and export standpoint, they can't produce themselves out of it. This is why they're forced into austerity. But think of it this way. If the next level of austerity hits the private sector because the government is running out of money to stimulate the overall economy, you're going to see bankruptcies in many small businesses and many individuals throughout these countries. That's another trigger into the European banking system of defaults on loans. So ultimately, to us, we're not quite sure how they get out of this, and we have a very pessimistic view of this. We see sovereign default probably in Greece, but you also have to figure what happens here if the European banking system gets into trouble because of this. The first thing they're going to do is pull in all their credit lines from the periphery. I talked about Latvia. They're in the Baltics. They're just getting crushed. Those credit lines are primarily all international banks, Swedish banks, German banks, Greek banks, Austrian banks, Swiss banks, and they will pull in those credit lines from there. So a sovereign default within the core, something like Greece, as we said, which is number one on the hit list, will spread quickly to the Baltics, and we probably see sovereign defaults in the emerging market countries of Europe, the Central and Eastern European countries. That further feeds into to the European banking system, and it all ultimately feeds back into the euro. So this is a pretty ugly picture in here, and you can see why when you look at this and you look at the relative exposure here to the European banking system and the relative exposure these governments have, why they've called the IMF into the equation. The IMF has been brought into the equation because Europe doesn't have enough money here. So that's part of the problem. Let's see, Mr. Chandler, can you hear me okay now? I see you've lost the sound. Everybody hear me okay? Great, thank you.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.